Markets off to a slightly shaky start in this fourth quarter due to the escalation of Middle East conflicts, but we do anticipate a strong finish to the year end. So just a few quarter three highlights. First of all, in July, August, we had a pretty sharp sell-off centered really on the Magnificent Seven shares amidst concern maybe that the AI hype might be overblown. Then we had the Bank of Japan interest rate increase, slightly higher than expected, sparked off an unwind of the yen carry trade. So the yen carry trade, investors borrow in cheap currency and invest in higher yielding currencies. And of course, with the Bank of Japan raising interest rates, there was a bit of a flight out of those yen carry trades, which involved a selling of risk assets. But the markets have enjoyed a swift recovery. There is a feeling that there will not be a recession. Strong earnings growth continue. And then, of course, the prospects of rate cuts also provided ballast to the markets. At the end of the quarter, a 50 basis point rate cut, strong stimulus from China. And our portfolios, the global portfolios, apart from the global growth portfolio, which was marginally negative, the other global portfolios enjoyed fourth straight quarterly gain. So that's incredibly good news for our clients. So this morning, a couple of topics. First of all, capital economics, a favorable outlook from them on monetary easing, earnings growth, and equity markets. And the snippets I'm going to share with you include some background and some forecasts. And we share those views. And then I think the other segment, which will be good, will be some analysis of China's stimulus announcement from Alpine Macro. We're starting off then with a capital economics segment. The 1990s rate cuts provide a point of reference. In addition to being generally well anticipated and skirting recessions, there are other potential similarities with the rate cut cycle. The 1995-96 cycle also featured, in Jay Powell's words, a recalibration of rates back to neutral after a period of aggressive hikes, while the smaller late 1990s easing cycle occurred around the same time as a yen rally, carry trade unwind, and inflation or an inflating tech sector bubble. Risky assets, incidentally, in the 90s, especially equities, generally powered ahead. We forecast similar outcomes for asset prices this time round. And then it's interesting just to look at the actual total return forecasts in dollars for the different markets. So between now and the end of 2024, the global MSCI All Country World Index plus 3.6%, the US plus 5.5%, Pacific developed markets plus 4.2%, and Europe minus 3.9%. However, between now and the end of 2025, it really gets quite exciting. Europe makes up its lost ground, so up 25.6% between now and the end of next year. And that is the best performing region according to this research. The global markets plus 19.7%, Europe, we've mentioned, the US plus 18.8%, emerging market Asia plus 16.8%, and developed market Pacific plus 18.2. They do expect a mild sell-off in 2026 as the economic cycle matures and we reach the end of the rate cutting cycle. So to sum up then, we expect US equities to return to the front of the pack before long as the AI rally resumes. With regards to interest rates, expect easing cycles in developed markets, which have begun in the US, UK, and New Zealand in the third quarter, to broaden out over the next couple of years. The Fed began its easing cycle with a bumper 50 basis point rate cut amid concerns over the outlook for the labor market, but we expect it to switch to more moderate 25 basis point cuts over its upcoming meetings. In our view, recent data are consistent more with a slowing economy than a recession. In total, we forecast 175 basis points of further easing, with the policy rate bottoming out at 3 to 3.25% in mid-2025. Turning to the European Central Bank, we forecast one 25 bp cut in every quarter until the deposit rate, currently at 3.5%, reaches 2.5% by end 2025. With regards to the Bank of England, where the base rate there is currently 5%, they're forecasting a drop to 3% by early 2026. Meanwhile, the Bank of Japan is in the middle of a tightening cycle exclusively, having already hiked by a total of 35 bips. We think it will deliver only one more hike in December of 25 bips. In emerging markets, the number of central banks cutting interest rates has continued to increase. Indeed, South Africa and Indonesia have both joined the EM loosening cycle in recent weeks. Bucking the trend is Brazil, whose central bank hiked its policy rate by 25 bips this month. We expect central banks in emerging market Asia to join the easing cycle this year. Clearly, that would benefit our clients' portfolios. And let's turn now to equities. We expect stock markets to keep making strong gains over the next year or so, especially in the US. We suspect that enthusiasm about AI will grow again and fuel a stock market bubble that will benefit tech stocks disproportionately. Our biggest holding, incidentally, is a tech-centric investment company, Allianz Technology, which has done incredibly well, although not so well in Q3. Hype around AI has waned a bit over the summer, reflecting notably growing doubts about the sustainability of some firms' earnings growth. This resulted in a big drop in equities in July, led by the so-called Magnificent Seven, which had largely outperformed earlier in the year. Stock markets have largely recovered since then, with both the MSCI USA and S&P 500 indices reaching all-time highs in September, but this has reflected the strong performance of non-tech stocks. Our view is that the US economy will manage a soft landing. We suspect that any remaining concerns about a recession will prove misplaced. If we're right that the AI bubble will reinflate, then perhaps the appropriate comparison is the dot-com bubble of the late 90s, early 2000s. Valuations are still generally much less stretched than they were then. The upshot is we expect further large gains in the US stock market, We forecast the S&P 500 to end this year at 6,000 and to end next year at 7,000. We think that other developed market equities will generally make decent gains, although not as large as those we expect for the US. Moving on to MRB macro. The macro backdrop is positive for the global economy and capital markets, with developed market policy rates easing even in the absence of the typical recessionary backdrop. Rather, corporate profits are already performing well and are now being given a further boost by lower borrowing rates and yields. The global easing cycle is in full swing, with China also adding to the impetus to boost asset prices and support economic growth this week, following the Fed's sizable rate cut last week. In terms of an important economic signal that there is no recession, high-yield corporate bond spreads did not rise significantly before policy rate cuts began and remain historically low. This is most unusual relative to past rate-cutting cycles and is not consistent with deteriorating growth or a looming recession. The macro backdrop for global equities is becoming increasingly favorable. Policy rates are heading south. Global trailing and forward earnings are in strong uptrends, with profit margins at multi-decade highs. And then just a few things from MRB on the China stimulus before we move on to the analysis from Alpine Macro. It really was significant. Several interest rates were trimmed. The one-year medium-term lending facility cut by 30 basis points. The reserve requirement ratio for banks reduced by 50 bips, in theory freeing up 1 trillion of capital for lending by the commercial banks, and also a cut to existing mortgage rates expected to be 50 bips, as well as reducing the minimum down payment for a second home from 25% to 15%. On top of that, the provision of various funds to support the stock market and housing markets. 500 billion yuan will help brokers and insurance companies to buy stocks. A further 300 billion offered directly by the Bank of China, People's Bank of China, to finance share buybacks by companies, on top of an existing 500 billion yuan facility from the People's Bank of China to help local governments buy unsold housing inventories. The measures are clearly pro-risk and equity supportive. The People's Bank of China could indeed claim that they have delivered an all that it takes commitment to raise the price of risk assets. And all that it, if you recall, was the expression used by Mario when he inflated the Eurozone sovereign debt market. So, some analysis finally from Alpine Macro. Please bear with me. Last week's monetary stimulus package is more aggressive and comprehensive than all previous reflation efforts. With the Fed having begun to cut rates aggressively this month and the dollar trading on a softer path, the fear of a plunging yuan has greatly diminished, allowing the People's Bank of China to take bolder steps to reflate. Economic pain in China is palpable, with youth unemployment having surged to 19%. Local governments have run out of money. And the other reason is that heading into the final quarter of the year, the economy might not be hitting the government's 5% target. The sudden policy reversal is reminiscent of the sudden rehearsal of the senseless zero COVID policy in 2022. What is encouraging is that authorities have indicated that last week's stimulus form the first installments of policy stimulus. More support is forthcoming. So what still needs to be done? First, aggressively cut interest rates. The benchmark loan prime rate is still very high in real terms. With the economy stuck in a liquidity trap, fiscal stimulus is far more important than monetary policy. There's no point cutting interest rates if there's no desire to borrow. The key difference here is that President Xi Jinping was very explicit in last week's Politburo meeting, stressing that active fiscal and monetary policy, particularly public sector spending, are necessary to safeguard economic growth. How could this be achieved? In a similar way to how the US Federal Reserve sponsored funding after the COVID crisis. The People's Bank of China needs to underwrite Beijing's fiscal expansion and do so quickly. The key indicator to watch is the speed and magnitude of the PBOC's balance sheet expansion. So far, there is no sign of a significant liftoff. Both the balance sheet expansion and Beijing's fiscal deficit pale in comparison to the US. And I think this is the key point. It underscores the huge potential for large-scale monetary and fiscal expansion by China if it starts moving those parameters to US levels. Should the PBOC ramp up its balance sheet quickly, it would be a very bullish sign for asset markets in China, particularly if we look at their incredibly cheap levels. Chinese equities are selling at a 40% discount to European equities and a 60% discount to the US. And there would be other benefits. A stabilizing Chinese economy will help commodity prices and boost the global economy. Any policy reflation is a positive for US equities and obviously very good news for cyclical economies and markets such as Germany and Japan. Both their economies are closely integrated with China's economy. So quite a bit there to digest. And Sean, over to you on the local side.
I can provide you guys with a quick update on inflation, the recent interest rate decision made by the MPC, the ABSA PMI figure that recently came out. I'm touching on the exchange rate briefly, and then finally just ending off on the OAM local portfolios. So starting off with inflation, the annual headline producer price inflation, or PPI, moderated significantly in August, coming in at 2.8%, which was down from 4.2% in July. This marks the slowest increase in producer prices since July last year, and the slowdown was mostly driven by softer price increases in petroleum, chemicals, and rubber and plastic products. However, looking at food inflation, excluding beverages and tobacco products, that edged up slightly to 3.4% year on year in August, from 3.3% in July. Overall, the moderation in PPI suggests that consumer price increases are also likely to continue trending lower in coming months. Moving on to the interest rate decision, the Reserve Bank recently cut the repo rate by 25 bips, bringing it down to 8%. That leaves the prime lending rate at 11.5%. So overall, this has been received well by the market, among other factors, with the JSE also rising about 3.34% during the month of September. And as you all would have seen, the local portfolios have captured some positive gains as well, ending Q3 quite nicely, nice and strong there. The next question that's on everyone's lips, I guess, or everyone's lips, is how low can the MPC go? So I had a look, and Momentum Investment Group believes another 25 bit cut could take place at the final MPC meeting of this year, which will take place in November. And another 2 more 25 bit rate cuts are expected in 2025, ending the year at 7.25%. So overall, pretty much in line with previous expectations of a total rate cut of 100 bips. However, nobody is quite certain as to how aggressive the MPC will be with their rate cutting cycle. The ABSA PMI figure. So the September figure came out yesterday. South African manufacturing activity increased in September, recovering from the previous month's slump as demand rose and an interest rate cut boosted sentiment. The seasonally adjusted PMI figure rose to 52.8 points in September, coming from 43.6 in August. So the figures therefore moved from contractionary into expansionary territory. Both domestic and export demand showed signs of improvement. And with continued interest rate cuts expected in the country, that should also add to the increased local demand. The ABSA report also noted that the positive PMI results suggest that the manufacturing sector is stabilizing after a turbulent period, although there are challenges that do still remain, particularly when it comes to employment. The ZAR exchange rate. So Nick, as you mentioned in your update there, the China stimulus package has definitely brought some confidence into the market. And when we look at the end of last week, the Rand exchange rate was all over the headlines. I'm sure everyone noticed. It continued its recent strengthening, with the rate dipping below the 17 Rand 15 mark to $1 USD. The China stimulus announced definitely helped the commodity currency as well as the general risk appetite in South Africa. And just looking at end of close yesterday, the rate closed at 17 Rand 40. But when we zoom out a bit, on a year-to-date basis, the ZAR has increased by more than 5% relative to the USD. So that's the first time we've seen this in years, which is quite a positive signal. However, how sustainable that strengthening may be is another thing entirely. That's all from me, Nick.